So hello guys, I believe you are well today. So today I want to address a question that I've been asked a lot about position sizing. I've received a question like what is the correct lot size that I need to use in my account if I have maybe a particular amount of money. So what first of all you need to understand, you need to apply what we call proper risk management. Okay, so proper risk management, and we said that the rule of thumb when you're doing proper risk management, the rule of thumb is do not risk more than 1 to 2% of your account. Okay, do not risk more than 1 to 2% of your account. So that is a rule of thumb that you should always know when it comes to Forex. Okay, so do not risk more than 1 to 2% of your account. So let me begin by an example of maybe $100 account, because probably maybe most of us can be able to start with $100. So with $100, when you're risking, let's say, we take two examples, 1%, you're risking 1%, and also you're risking, let's say you're risking 2%, okay? But as a beginner, you need to begin with the lowest risk, that is maybe 1%. So what is 1% of $1,000? Okay, what is 1% of $1,000? So you find that 1% of $1,000, that will give you $1. Okay, so if it will give you $1, then definitely it means that this is the risk that you're going to take in this account. Okay, this is the risk that you're going to take in this account. So if you're risking $1, then it means you can only take a position. Okay, you can only take a position of 0.01 and only risking 10 pips. Okay, risking 10 pips. Right, so you'll be having a 10 pips stop loss, right? So again, so for you to enhance your maybe productivity, so if you are risking 10 pips, okay, if you're risking 10 pips, then it means your reward, okay, so it means your reward should be using a risk to reward ratio of 1:2. Okay, we are using a risk to reward ratio of 1:2, right? So using a risk to reward ratio of 1:2, so it means if you're risking 10 pips, then definitely you'll be shooting for what? You'll be shooting for 20. You'll be shooting for 20 pips. Okay, you'll be shooting for 20 pips, and that basically will give you, in terms of monetary value, that will give you what we call maybe $2, right? So it will be $2 and maybe around 1.903 when you factor the commissions by your broker. Okay, so if maybe probably for the same $100 you are risking, let's say, or maybe let's say maybe for instance you have a $200 account. Okay, so you have a $200 account. So with $200 account, when you're risking 1%, when you're risking 1%, definitely that will be it will give you $2. So you'll be risking $2, and this means that you can do there are two options. You can either do a lot size of 0.01, okay, and now you risk what? You risk 20 pips. Okay, you risk 20 pips. Okay, or you can also do a 0.02 and you risk 10 pips. Okay, you risk 10 pips. Either of them will give you, if your stop loss is hit, it will give you a loss. You'll incur a loss of $2, right? So what will determine whether maybe you'll risk 0.01 or 0.02 depends on the high probability of the trade, depends on the nature of the trade. Is it a high probability trade? Okay, is it a high probability trade? Because there are some trades, when you get used to the market, there are some trades that you'll see and you know that this is a high probability trade because it has a lot of confirmations. Okay, so with that, if again, depending on your strategy, if you can be able to risk 10 pips, well and good. Again, depending on your strategy, if you cannot be able to risk 10 pips, maybe you can risk 10 pips, 20 pips. So what will happen now, if now maybe probably you have a strategy that does not allow you maybe to use 10 pips, 20 pips, etc., etc. So what happens in such kind of a scenario? I always advise that as a beginner, okay, as a beginner, just try to do in the lower time frame. Okay, when you go to the lower time frame, you'll be able, like 5 minutes time frame, you can be able to get very nice entries even with your strategy that will give you maybe a risk to reward ratio. That will give you maybe 10 pips stop loss or 20 pips stop loss. Okay, so in the lower time frame you can be able to get that. So it's good you begin in the lower time frame, and in the lower time frame again it means scalping. Okay, it means scalping, so you have to scalp from the lower time frame so that you can get high probability trades that are that have minimal or minimum risk, let's say 20 pips or maybe 10 pips. Okay, so if you'll be shooting for 20 pips, then it means then your reward you should be targeting maybe 40 pips. Okay, you should be targeting 40 pips. And if you are taking 10 pips, then it means you should be targeting what, 20 pips, right? So either of them, they'll give you you find that you'll have these will give you 4, right? So if you're using 0.01 and target 40 pips, that will give you $4, right? So also this one will give you $4 as well, $4, right? So you can see you're risking, risk to reward ratio is 1. You're risking $1, you're risking $2 to make $4, or you're risking $1 to make $2. So at the end of the day, it becomes a profitable business. Okay, so let's look maybe someone who has $500 account. So definitely you're risking 1%. Okay, so you're risking 1%. So when you're risking 1%, then that means you will have that will be 1 times okay, so let me just do the mathematics well, so you can just cancel that. So we already have the percentage here, so we are risking 1%. So what we'll be having now is so it will be 1% multiplied by 500. So don't know why it's becoming that, I don't know. So let me do it here, maybe 1%. Okay, that is 1%. So 1%, if you multiply the 1% multiply by 500, so you get $5. So you'll be risking $5, right? You'll be risking $5. So here you can have different options, again depending on how your account is. Okay, so the first option maybe 0.01. okay, so 0.01 you risk here, you can risk 50 pips. Okay, if your strategy maybe has a huge pip, you can also do 0.02. okay, so here you'll be risking let's say 25 pips. okay, 25 pips. You can do 0.03, and here you'll be risking close to around, let's say 15 pips. Yeah, 15 pips. Also you can do 0.04. okay, so here you'll be risking what, you risk here you can risk 10 or let's say 10 pips, right? 10 pips. And also you can do 0.05 and you risk 10 pips. Okay, so what we'll be having here is you'll be having now if you're shooting for 50 pips, it means that if you're using a risk to reward ratio of 1:2, then you'll be shooting for 100 pips. Here then you'll be shooting for 50 pips, so it's double of what you're risking. You'll be shooting for 30 pips, and here you'll be shooting for 20 pips, and also you'll be shooting for 20 pips. Okay, so you find that with the first option here, this becomes like swing trading, because you have a huge risk, so you have to minimize what, the lot size, and then your target is high. So this is more of swing trading. Okay, this is more of swing trading. So that is swing trading. Okay, that is swing trading. And then what you need to understand is that the higher the risk, the lesser your lot size. Okay, the higher the risk, the lesser your lot size. So as we minimize the risk, okay, as we minimize the risk, then we can increase what, the lot size, but still within the 1%. Do not risk more than 1% to 2% of your account. We are working with an example of 1%. Okay, so in this scenario, you find that if you're risking $5, then you'll be looking to make $10. Okay, you'll be making $10. Okay, so also in this scenario, you'll also be making $10. So in this one, if you have so these will be around also you'll be targeting to make $10 here. Okay, and also with this other one, you'll be targeting to make as well 10. So if you're using a 0.04, okay, if you're using a 0.04 for 10 pips, that is 40, that is $4. And actually, so you'll be targeting what? $10. So this as well, our target is $10. So remember, every time if you are risking $5, then we need to target, like, let's say, to make $10. Okay, so that you can be in a risk to reward ratio of 1:2. Okay, so here as well, these are 20 pips, right? So you can see now with an account. Okay, so we can deduce this and say that with an account of $100, you can only use a lot size of 0.01. Okay, so and then you risk what? 20. You risk 10 pips. Okay, you risk 10 pips. Okay, this is the summary. So with an account of $200, risking 1%, okay, $200, risking 1%, you can use a lot size either 0.01, okay, to a lot size of 0.02 maximum, right? So you can do that. And here, if you are using now 0.01, you'll be risking 20 pips. If you're using 0.02, you'll be risking 10 pips, right? So if you have a $500 account, okay, if you have a $500 account, then that tells you you can do 0.01 to 0.05. Okay, so again, you have to understand, if you're using 0.01, you have a 50 pip stop loss. If you're using 0.02, you have a 25 pip stop loss. If you're using 0.03, you have a 15 pip stop loss. If you're using 0.04, you have a 10 pip stop loss. And if you're using 0.05, you have a 10 pips stop loss. Okay, so let's say maybe, for instance, in this scenario, the first scenario, actually, here it means you're taking one trade at a time. Okay, one trade at a time. Okay, one trade at a time. So until your trade maybe hits your stop loss or to hit your TP, then you cannot open another trade. Okay, you cannot open another trade. Then in this account, if you're using 200 in a $200 account, it means you can be able to open let's say one account, one trade of 0.01, and you risk 10 pips, you risk 20 pips, or you can be able to open one trade of 0.02 and you risk 10 pips. Okay, so that is one trade at a time. Okay, one trade at a time. But if you get maybe one trade, you are risking 10 pips using you can use 0.01. Let's say maybe, for instance, you take a Euro USD, you risk 0.01, then you use 0.01 and then you risk 10 pips. You can also maybe get another entry maybe for CAD JPY. You use 0.01 and risk 10 pips. Okay, so that cumulatively you'll not have risked more than 20 pips. Okay, if you have two trades running concurrently. So what I'm trying to insinuate is that here you can open maybe two trades, but in these two trades you have to use 0.01, and in each trade you are risking 10 pips. Okay, so there can be different options. Okay, but I want to train you to be taking one trade at a time, such that once your trade hits take profit, now you can be able to do what? Once your trade hits take profit, you can be able to take or to look for another entry. Okay, so in this scenario as well, we are assuming you are taking one trade at a time. So you can either have a trade of 0.01 and you risk 50 pips. So you wait until your trade hits your stop loss, and then you'll be, or maybe you take profit and then you look for another entry. As well, when you're doing 0.02, you risk 25 pips. So you can wait, you can take that trade one at a time. You wait again until it hits either your take profit or your stop loss, and then you look for another entry. Okay, so when you're using maybe a 0.03 lot size, so you need to take one trade at a time. Okay, but again, here, let's say you can take, like, let's say you can be able to take, like, for instance, 5 trades when you're using 0.01 and you're risking 10 pips. So it means that you can be able to take you can be able to take 5 trades at the same time. Also, when you're using 0.02 and you risk, let's say, when you have 5 trades, you're taking 0.01, risking 10 pips per trade. Or you can have 2 trades, 0.01, 2 trades of a lot size of 0.01, and in each trade you're risking 25 pips. Okay, so the essence of this is always to ensure that anytime your trades are running in the MetaTrader, when you combine the total positions that you have that are running, that should not exceed 1%. The risk should not exceed 1% of your account capital. So if you don't know how to do that simultaneously, or to be able to curb that, how to do it consistently, then what you need to do is to take one trade at a time. Okay, you need to take one trade at a time, and that will be very beneficial. It will be able to help you in a greater deal. Remember, we said the goal of trading, the goal of Forex trading, remember what we said. Number 1, it is to protect your capital, and number 2, it is to minimize your losses. Okay, so, and another trick in terms of risk management, it is always to ensure that you are looking to make more than you are risking. Okay, so the reason why we have a risk to reward ratio of 1:2, meaning that if I am risking $1, then I am aiming to make $2. If I am risking $2, then I am aiming to make $4. If I am risking $5, then I am aiming to make $10. Okay, so the reason why that is important, again, I'm going to illustrate here to you. So you can have, let's say, I'll give you a sample of 10 trades. Okay, a sample of 10 trades. So in these 10 trades, we want to just an assumption that we are risking $10. Okay, we are risking $10. So the first trade, we make our $10. Okay, so we make our $10, the first trade. The second trade, we make our $10. Okay, so our $10. So in the third trade now, because you have 2 consecutive losses and 2 consecutive wins, and as a beginner, that might tend to bring some overconfidence. So you find that the next trade here, you'll be doing what? The next trade here, you'll be so all this actually is the risk. Okay, so all this is the risk. So this is the risk. So all this is the risk. So, okay, so let's have this as the risk, right? So this is the risk. Let me do that way so that you can understand. Okay, so then this, you are looking at the reward. Okay, so let's say the first trade, if you are risking $10, then it means you are aiming for $20, right? So let's say the first trade was successful and the second trade too was successful. But now the third trade, because of overconfidence, because you have 2 winning streaks, you become overconfident and then you make a bad decision, and then in that trade you end up losing what? You end up losing $10. Okay, so it will be negative $10. So because again you have lost $10, it affects your psychology again, and you want to do maybe revenge trading, and again what will happen is that now you'll also lose another $10, right? So you'll have maybe, let's say, a streak of let's say three losses. Okay, so you have a streak of 3 losses. So then now you sit down, you reanalyze yourself, you gather your confidence again, and then now you start trading. So meaning the next trade, probably it will be a winning trade. Okay, it will be a winning trade. Then the next trade, maybe it can be a losing trade because you're not sure of yourself. You have already panicked. You have lost some money here. So the next trade, maybe again, it can be a sell, it can be a loss. So if you lose, you are losing $10. If you win, you are winning what? $20. Okay, so this can be a winning trade. Let's say this becomes a winning trade. Okay, and then the last one becomes a losing trade. Okay, the last one becomes a losing trade. So we lose $10. Okay, so from this we can see our winners trades. Okay, winners, there are 4 trades, right? And losing trades or losers, they are what? They are 6, right? So in the normal way, if you go and tell a person, okay, if you tell a person who has not done, who does not understand the risk to reward ratio, definitely you are a loser, because here you are 60%, okay, 60% losing and 40% winning, okay, 40% winning. But shock on you, if you do the math here, so you have lost what? So in terms of winning, so if you're winners, in your winners, it means that when you win, you're making $20. So how many times did you win? 4 times. So this means that how much did you make in your winning trades? So you made sorry, you made 80 or $80, $80. Okay. So anytime you lose, you are losing $10, and you had 6 losing trades. So 6 times 10. So you'll have lost you will have lost $60, right? You'll have lost $60. So that is $60, right? So at the end of the day, when you do the math, so you'll find that end of day, okay, so end of day, you find that actually you'll be 20% profitable. Okay, you'll close the day with $20. So is that a losing day? Definitely no. But what saved you? The risk to reward ratio. So that's how important the risk to reward ratio is. And you should always consider, if you follow this formula, and especially as a beginner, because in your beginner's level, you find that you might be having some substantial amount of losses. But what will be able to protect you, your capital, and also help you minimize losses is the risk to reward ratio. So always aim to do a risk to reward ratio 1:2. You are risking $1 to make $2, because at the end of the day, like I said, if you just go and tell someone that you are 60, your day was 60% loss and 40% wins, definitely at the back of the mind of that person, it will be like you lost in that particular day. You lost, okay, because you are losers 60%, 40%, and winners 40%. So losses are more than wins, okay. But theoretically or mathematically, you find that because of the risk to reward ratio, then at the end of the day, you'll be 20% profitable. And guys, that's how you are able to trade slowly, especially in your beginner's level, until you build confidence, okay, until you build confidence. Now, you as you continue trading, as you get experience with the market, your key aim is to minimize these losses, okay. Your key aim is to minimize these losses. And at the end of the day, you'll find that your profitability ratio will keep on increasing, okay, as long as you don't over leverage, as long as you don't become greedy, as long as you follow all the rules or the psychological rules in terms of forex trading, then you'll find yourself becoming successful in the long term, okay. So this is how we do to get the lot size. So I believe it was of value, okay, I believe it was of value, and that you'll be able to take some useful information from this particular video. Okay, so thank you, and see you in the next tutorial.